So one of the biggest problems that we face as traders, right, is that when we find a strategy and we encounter some winning trades, right, we get this euphoric feeling from the wins that we take, and all of a sudden, somewhere down the line, we run into a string of losses, right? At that point, we feel like that we are doing something wrong and that the strategy doesn't work, right? So we begin this quest for a new strategy, right, or for new information, right, that can help us increase that win rate and curve those losses that we just took, right? Stop doing this. Don't do that, right? Today in this video, I'm going to show you something that will shift your thinking and understanding about trading as a whole, right? In this video, I'm going to hand you the key that will allow you to unlock the door to consistency and stop you from running around in circles and wasting your time, okay? I'm going to show you why you go through those strings of losses and wins, and that's going to give you the wisdom to persist through those losses, right? And I'm going to show you a strategy to better deal with those strings of losses, right, that are inevitable. So without wasting any time, let's get into the video. How's it, guys, and welcome back to Paradigm Flip. Hope you're all doing well. And yep, you guessed it, we're going to be talking about risk management, right? But we're going to be taking a deeper look at risk management, and we're going to be looking at how and why traders encounter the string of losses that they incur, right? And we're going to be looking at how to deal with them, okay? And I'm here on this article on the FTMO website, and it's a very lovely article. It has everything that I need to talk about in one place. Okay, now I'm just going to skip the basics because I'm going to assume that we are all aware about the basics of risk management. Okay, now if we just scroll down, right, there's this heading here, risk per trade. Okay, so it reads, how much should you be risking per trade, right? In most textbooks, right, the standard amount that we learn to risk is 1 to 2% of our account, right? And it's written here, although the answer is more complicated, right? So if we just start with a 2% risk per trade, right, and we just scroll down and we see this table that's drawn out here, right? If we take 10 trades, okay, and each trade we risk 2% per trade, right? Off the bat, right, if you start with a $20,000 account, when you risk 2% on that trade, if you lose a trade, right, assuming that you lose a trade, right, or assuming that we are headed into that losing streak, on the first trade, right, risking 2%, we're going to lose $400, right, and that's going to leave your account balance, right, at 19,600. And if we continue to risk 2%, right, we will lose $392 on the next trade. Now, if we do this for 10 trades in a row, right, we can see the equity has gone down to 16,675. Now, the article reads that, right, if you risk 2% per trade, it will approximately cost you 20% of your account on 10 consecutive losses, right? And you might be thinking, that's fine, you can stomach that, okay? And might be so, okay? And it's compared and contrasted with a risk parameter of 10%, right? Where you risk 10% per trade. And if you see the table, right, if we risk in 10% per trade and we incur 10 consecutive losses, right, we're going to be left with 7,748, right? And that's going to be 60% of your account gone. Now, if we just scroll down, right, there is a table here that explains if you have lost X amount of your capital, right, or if you are in a certain percentage of drawdown, how much is going to be required for you to get back to break even, right? So how much is going to be required for you to get back to your initial capital? And you can see when we actually incur a 10% loss, you're going to need 11%, right, to get back to that break-even number, right, and so on. So if you look at the one below, right, we got 20% loss, you're going to need 25% to get back to break-even, right? And as we go lower on this table, right, if you see if you incur a 50% drawdown on your equity, right, you're going to need 100%, right, return just to get back to break-even. Okay, so this increases as our drawdown increases, right? It gets more difficult to grow back your account, right, back to the original capital, right? And just looking at this 20%, right, if you incur 20% drawdown, right, you're going to need 25%, right, to get back to your original capital, okay? And that would be after 10 consecutive losses, okay? Now, you might look at that and think it's fine, but this is going to be very difficult to stomach, right, or trade through this, right? At this point, you'd probably be thinking that you're doing something wrong and you're going to give up, okay? And your psychology is not going to be in the right place and you'll end up messing up and it's going to lead to a downward spiral, okay? So what exactly is the probability of losing 10 consecutive trades in a row? Well, if we are looking from the perspective of your trading strategy, in order to understand this, you would have to know or have an idea of your win rate, right? If you want to know what's the probability of losing 10 consecutive trades in a row, okay? And most traders are trend followers, okay? Or trade in the direction of the trend. And generally speaking, a trend following system is going to have a 30 to 50% win rate, okay? Now, in front of us here, what I have is a profit and loss distribution of a trend following system, right? And on average, a trend following system will have a profit and loss following this kind of distribution. And let's just take a look at what this distribution means, right? So we can understand what we're talking about here. So this is the trade distribution histogram of a classic trend following system, right? Based on R multiples. Now, R multiple simply means risk to reward, right? So it's based on how much you're risking to how much you get rewarded on a trade, right? And a trend following system will usually have a risk reward that looks like this, right? Where you're risking a certain amount and the amount that you're looking to gain is far exceeding the amount that you're risking, okay? And a trend following system, right, the profit and loss distribution of such a system, right, generally follows a distribution that looks like this. Now, what does this tell us? Okay, so if we just look at this distribution, what we have is we have the frequency of trades on this scale, right, and this is the frequency of wins and losses on this scale, right? And what you'll notice, right, is that a lot of the data is distributed around 0, right? So what this indicates is that a high frequency or a high number of these kind of trades, right, is going to be a break-even trade, right? And we'll notice that there's still a lot of data around these points, right? And that basically means that we will have data points or trades around these areas. So if a trade lands within this area, right, this is a trade that occurs a loss, right? And if we have a trade in this region, right, that's a trade that incurs a small profit. Okay, and the majority of them are going to be break even, right, and small losses and small profits, right? So this means that if you are trend following, a lot of your trades are going to be exited around this area. A high frequency of your trades are going to be exited either in a small profit, right, or for a loss or for break even. Okay, and very few trades, right, reach your target, right, reach that fat tail, right, which far exceeds, right, your stop loss. Okay, and it's these trades that are going to be growing your account. Okay, everything happening in here, right, is either growing your account slowly, right, or reducing your account slowly, right, and this also depends on how frequently you trade. Okay, but the idea is that very few trades will actually reach target. Okay, and because of this, right, a trend following system will generally have a win rate of 30 on the low end to 50% on the high end. And if you have a trend following system with a 50% win rate, that's really good. Okay, right? So this is what we can generally expect out of a trend following system, because most of the trades, the profit and loss of the trades are distributed, right, around the entry price, right? And very few trades go on to make a large profit. Okay, and this doesn't mean the system is a losing system. These trades are what is going to basically grow your account, right, over time. Now that we have a general idea of the win rate, right, most retail traders fall in this category, okay, of trading. And if we now have an idea of what you can expect from your trading system, right, just a crude idea, we can now go and look at the probability, right? Now that we know the win rate, the possible win rate of your trading system, we can go and look at the probability of incurring 10 losses in a row, right? 10 consecutive losses. Okay. So back here on the page, right, if we just scroll down, right, we will reach this little table here. And basically, this is a table that shows you the probability, right, as it reads the probability of seeing X consecutive losses, right, within a sample of 50 trades. So basically, in a sample of 50 trades, if you take 50 trades, right, what's the probability of seeing a certain amount of consecutive losses in a row, right? And if we just start on the low end, right, 30%, right? So if you have a 30% win rate, okay, if we just move along this area, right, and we line it up with 10 trades, right, the possibility of losing 10 trades in a row, right, is 69.1%, right? So if you have a system with a 30% win rate and you take 50 trades, right, within a sample of 50 trades, you have a 69.1% probability of seeing 10 consecutive losses in a row, right? And that should be mind opening, right? Because that should let you know that within 50 trades, right, if you have a 30% win rate, you are most likely going to run into those 10 consecutive losses, okay? And if you are risking 2% on each trade, right, you will most definitely, right, with high probability, run into a 20% drawdown, right, within 50 trades. Now, this is a 69% probability. There is still a 31% probability that you might not encounter these 10 consecutive losses, right? But regardless, right, it's still a high probability that you'll run into them, right? And you can see if you just go to the left here, if you look at the probability of having 9 consecutive losses, right, within a 50 trade period, right, if your win rate is 30%, right, you basically have a 82% probability of undergoing 10 consecutive losses, and that's extremely high, right? So the idea is to plan for these losses, right, ahead of time. And now maybe you can understand that maybe risking 2% on your trading, right, is actually extremely high, right? Because you can easily get into a 20% drawdown, right, within 10 trades, right? And even if you increase your win rate, right, if you have a 50% win rate, you can see that we have a 97% chance, right, of undergoing 6 consecutive losses in a row, right? So it's better to prepare for these losses and expect them to occur, right? So now you understand that this has nothing to do with your trading system. This is just the probability and statistics, right, of trading itself, okay? Right? So the next question now becomes, how can we deal with these losing streak trades that are clearly inevitable? How can we mitigate, right, the losses when they start to occur? Because we don't know where in our trading cycle this may occur, because our risk management strategy needs to take this into account beforehand. Okay, so next up I'm going to show you exactly how we can do that, right? That's going to better position you, right, to encounter these losses and to persist through them, right, without psychologically being affected in your trading. Okay, so if we just scroll back up to this chart, right, where we see that we have a comparison between a 2% risk and a 10% risk on a 20K account, right, and we encounter 10 consecutive losses. Now, what I've done is I've drawn up a new table showing the drawdown, right, of a 20K account, right, if we incur 10 consecutive losses. However, with a different approach to managing risk, right? And basically, what we want to do is that we want to be more dynamic with our position sizing, right? So instead of keeping your risk fixed, right, at 2%, okay, we want to be dynamic about this, okay? And basically, what we want to do is that when we encounter a loss, so let's say we take our first trade, right? And we risk 2% on that trade. Okay. And we obviously lose $400, right? Which is going to be 2% of your account, right? As soon as we take that loss, you're going to bring down your risk to 1%. Okay. And if we then encounter another loss, right, of that, of the trading account, right, we will now lose only 1% of the trading account, which is 196. And after losing this trade, we'll automatically cut the loss to 0.5%. Okay. And you can see the change, right? If we stick to that 0.5%, right, after incurring 3 losses in a row, right, and we stick to that 0.5%, okay, you can see how the loss flatlines, right? So your drawdown becomes flatter. Okay, so after 10 consecutive losses, right, we can see that the total drawdown, right, is only 6%. Okay, and you will keep this 0.5% risk until a time when you start to see a turn in your equity curve, right? So when you start to make profit, right, then you start to scale back up to 1%, right, and 2% on the maximum end, until you incur another loss, right, and you scale back down, right? So we're going to be moving, right, along this risk curve, right? Our winning trades, right, we're going to be increasing our risk, right, up until 2%, right? But if we ever encounter a loss, right, we're going to bring our risk down to the next level, right? So if you are currently risking 1%, right, and you win your trade, right, you bring your risk back up to 2, right? And if you lose the next trade, you bring it down to 1. And if you lose the next trade, right, you bring it down to 0.5, right? And you keep it at 0.5 until you get a winner, right? And then on the next trade, you bring it back up to 1, Okay, and if you lose that trade, you bring it back down to 0.5. And basically what this is going to do, if we just go to the right here, okay, this is going to flatline your drawdown. So if this is your equity curve, right, and let's say this is your starting balance, okay, and let's say your first few trades or wins, right, so your equity goes up, okay, and then you encounter the big consecutive losses, right, and the first trade, right, you put on is a 2% loss, right, you will see a 2% loss reflected on your equity, right, and from there you risk 1%, right, and you'll see a 1% loss on your equity, and you move your risk down to 0.5%, okay, and you lose that trade still, what you end up getting is your equity curve flatlining, right? And if you keep your risk at 0.5%, right, your equity curve basically stays flat, right? So your capital is now preserved, okay? And on the flip side of that, just as it's probable that you'll encounter consecutive losses, right, it's also probable that you will encounter consecutive wins, right? And when you are going through a winning streak, right, we are basically going to be moving up on our risk, right? And basically, your winning streak will start small, right? And it's going to go up, right, as we increase our risk to 2%, right? So it's going to have this kind of hooking effect, right? That's going to stop your account from blowing, okay? Right? When you get these consecutive losses, and it's also going to increase, right, your gains, right, when you have consecutive winners, right? So your equity curve is going to expand, right, throughout your winning streak, okay? And this is basically going to reduce your drawdown and reduce the volatility of your equity curve, right, to the downside. Okay, it's basically going to create a floor, right, in your drawdown, right, and it's going to give a room to the upside for your equity curve to expand, okay, and that's going to allow more consistent growth in your trading, right? So now another problem comes where we want to calculate the risk per trade, right? How do you find that calculation, and how can you do it easily and fast, okay? And there's a quick and easy way that I do it instantly, okay? And it really takes only a few seconds, and I'm gonna share that with you guys in my next video. So if that video is available, you can find it linked here. So if you enjoyed this video and it added value to you, please hit the like button. Please subscribe to be updated for future content. And until next time, see you on the flip side.